Welcome to BD Daily Finance News Podcast, your daily briefing on finance and investing. It's 2025, December 30th, and we're doing a tight, actionable lap around oil, silver, and a bit of Federal Reserve political theater.
Year-end markets are like the last slice of pizza at a party. Everyone's hovering, nobody admits they want it, and then someone makes a chaotic move. Let's make people smarter than their group chat.
Story 1. Oil. The headline is basically, oil held onto gains because geopolitical risks are countering the "we might have too much supply" outlook. Traders are weighing tensions from Venezuela to Russia and Iran against the idea of a global glut.
So oil is doing that thing where fundamentals say calm down, but the world says absolutely not. This is like meal prepping, and then your oven catches fire. You still end up ordering delivery.
Exactly. The finance behind it, oil prices are part supply and demand math, part insurance premium. When geopolitical risk rises, markets add a risk premium because future supply could be disrupted, even if today's inventory looks fine.
Insurance premium is such a polite term. It's basically the market saying, we are nervous, and we are billing you for our nerves. Who pays that bill? Me, at the gas pump, right?
You, plus airlines, trucking, and any company shipping physical goods. Actionable take, watch 3 channels. 1. Crude itself. 2. Refined products, gasoline and diesel spreads. 3. Inflation expectations, because energy can reignite CPI narratives fast.
And for normal humans, if oil stays jumpy, it's not just road trips. It's delivery fees, groceries, and that mysterious fuel surcharge that shows up like a surprise tax.
Portfolio angle. If you're building a 2026 plan, decide whether energy is a hedge sleeve or a speculation sleeve. Hedge sleeve means small, diversified exposure. Speculation sleeve means you accept volatility and define exit rules before the headline hits.
Exit rules before the headline. Love that. Because after the headline, my rules are just vibes and panic. Okay, what's next? Metals doing parkour?
Story 2. Silver. We saw reports of silver rebounding after a major plunge. One piece notes the biggest one-day drop in over 5 years, followed by a bounce as year-end trading thins. Another notes silver recovered some losses while a lingering supply shortage keeps it on track for a strong monthly gain.
Silver is the friend who says, I'm fine, then texts you 47 times in 5 minutes. Why is it so dramatic compared to gold?
Because silver is both a precious metal and an industrial metal, it gets pulled by safe haven sentiment and by manufacturing demand. Add thinner liquidity than gold, plus leverage in futures and ETFs, and you can get violent moves, especially late in the year.
So it's like a hybrid car. Part I care about the planet, part I want to go fast. And then the software glitches and you're doing donuts in the parking lot.
Pretty much. Here's the actionable bit. If you own silver, position size matters more than being right. Use a smaller allocation than you would for broad equities, and consider rebalancing bands, like trimming after sharp spikes and adding only on planned pullbacks.
Don't YOLO the shiny rock because it had a good month. Also, year-end thin trading means prices can move like a shopping cart with one broken wheel.
Yes, and watch the narrative drivers. If the move is about supply shortage, that's different than a move driven by macro headlines like Fed minutes or a sudden shift in the US dollar. Same price chart, different risk.
Okay, so oil is geopolitics insurance. Silver is liquidity and leverage chaos. And now you promised Fed theater. Serve the tea responsibly.
Story 3. A profile piece on Kevin Hassett and how he became a Trump loyalist and a Fed chair contender. The market relevance isn't gossip, it's expectations. If investors think future Fed leadership could tilt more hawkish or more dovish, that can move yields and risk assets before any official decision.
So it's like when your boss hints there might be a new manager. Even before the manager arrives, everyone changes behavior, starts updating resumes, and suddenly the office snacks disappear.
That's a perfect analogy. Finance version: if markets price in a different reaction function, how aggressively the Fed fights inflation versus supports growth, you'll see it in the yield curve, mortgage rates, and equity valuations, especially rate-sensitive sectors.
And for normal people, That's your refinancing dreams, your credit card APR, and whether your safe savings account rate stays cute or goes back to being a sad little decimal.
Actionable checklist. 1. Know your rate exposure. How much of your budget is sensitive to variable rates? 2. Keep a cash buffer so you're not forced to sell risk assets on a bad week. 3. Diversify your inflation hedges. Don't rely on a single commodity to do the job.
Today's vibe, oil is the world's mood ring. Silver is a trampoline, and the Fed is a reality show where the plot leaks early and markets react anyway.
Quick recap. Oil is being held up by geopolitical risk premium despite oversupply worries. Silver's whiplash is amplified by thin liquidity, leverage, and mixed industrial plus safe haven demand. And Fed leadership chatter matters because expectations move rates before policy changes.
If you're listening while pretending to work, here's your micro action. Write down your max position size for any single commodity. Put it somewhere you can't ignore, like next to your buy the dip finger.
Subscribe to BD Daily Finance News Podcast for your daily briefing on finance and investing. If this helped, share it with one friend and tell them rebalancing is a calendar event, not a personality trait.
And if your 2026 plan is all just vibe, please at least vibe with an emergency fund. See you next episode.